Welcome to Fun with Annuities, where every single week I welcome a celebrity guest expert that can help you maximize Chapter 2 of your life. Listen, learn, laugh, and love every minute of the most unique financial podcast on the planet. Let's get to it. Welcome to Fun with Annuities. I'm your host, Stan, the Annuity Man, America's annuity agent licensed in all 50 states. I am so happy to have a repeat guest, personal friend, and the absolute guru, go-to person, expert in the field of long-term care. In addition to that, he does have his law degree, but don't hold it against him because he is a straight shooter just like I am. That's the reason I refer all of my long-term care business to him until he retires, so please don't retire. His name is Jack Lenenberg. Hello, Jack.
Hi, Stan. How are you?
I'm good, man. By the way, for all the listeners out there going, long-term care. Yes, exactly. Long-term care. And Jack has forgotten more than most long-term care agents will ever know. And this is all he does, and he does it very well. And he's national like I am. And we'll have this on our site where you can go, but his site is www.ltcpartner, PARTNER.com, www.ltcpartner.com. And you can schedule a call, get a quote, all that stuff. But he's the man. And speaking of that, Jack, I think we should talk about our current issues with parents. Right? Because Jack and I have been trying to do this podcast for a while, and he's doing some caregiving with this 86-year-old father. My mom is 84 and a handful, to say the least. And, you know, these are moments that I'm sure a lot of the people listening and viewing this are saying, yeah, I'm kind of going through that with my parents, either if you're not taking care of them, but monitoring them, which dovetails into the whole long-term care. Give us some reality lights. I was going to say highlights, but reality lights of what you've been dealing with here recently, Jack, because it's a handful.
It absolutely is. I mean, so I will say that it's actually not just with my father, but with my wife and I, we have starting about a year ago, a little over a year ago, with her mother. She started to mildly become cognitively impaired last summer. And, you know, my wife and my sister-in-law were taking turns to go to Florida to help her, to stay with her at home, make sure that she was safe, manage her medications, etc. But while they were going back and forth, when they couldn't get there, of course, we were bringing in round-the-clock home care for my mother-in-law, you know, and that lasted through this past spring, when we finally made the decision that, you know, we needed to relocate her from Florida to, you know, to Georgia, so that she could be near us. And we placed her in a beautiful assisted living facility. Right about at this time, my father had a fall in Pennsylvania at home. This was in April, and I received the call from his wife that he was in the hospital. So I flew in the next day. My father has Parkinson's. It turned out he had been in the hospital for over a week before his wife called me.
Great.
Over a week. And it also turned out that I discovered he had hid this from me for years. His wife has dementia. So that's why I never got a phone call. So for the past 6 months, he was in the hospital for 3 months with Parkinson's. He couldn't swallow. We had to make a decision. Do we put a feeding tube in him, you know, to get him nutrition to keep him alive? We waited 2.5 months to have the surgery, had the surgery. The next day he pulls out his feeding tube, Stan. had to have a second surgery. So fast forward to today, he's in a nursing home. And I'm going into Pittsburgh, typically every 3 weeks to make sure he's okay, monitor the situation.
Right.
And actually now I'm trying to assist his wife to get placed in a nursing home herself, because she can't live alone either. So it's
So
a
when we
lot in
talk,
the last
yeah, it's a lot. I mean,
a
it's a
lot.
lot.
It's just, in the last year, we've placed my mother-in-law in assisted living, and, relative to my father, she's doing great, right?
Hmm.
But my father, and now I guess my stepmother, in nursing homes. So it's, yeah, it's a lot, emotionally, and,
Hmm. Well, I always tell people there's three phases of retirement. There's go go, then there's slow go, and then there's no go. And if we're fortunate enough to get to the third one, that's great, but it ain't fun. Um, and I always tell my mom, who's 84 years old, getting ready to be 85. She lives in St. Augustine, Florida. She's very active. The only thing that's going to probably take her out is either dementia or falling. Falling's a big one. And she falls a lot, but doesn't tell me until I see the bruises, and her friends tell me. But one of the things that I just value, our friendship and business partnership relationship, however you want to call it, referralness, is that my mom is always asking me the question, should I keep my long-term care? Stan, which I didn't sell her. I don't sell long-term care. I said, yes, of course you do. Yes, you do. You're transferring the risk for that coverage, whether you need it or not. And what I like about Jack is he talks about the three types of long-term care that's available, which right now I think the most popular types are asset-based, meaning you're not losing the money. The money's not going down the rabbit hole like the traditional long-term care. But I think the reason we led with these stories is because of our parents. Is a lot of you are in those same life stages, and you want to make sure that your kids aren't having to do things that they don't have to do. And if you can prepare early for long-term care, that's great. So we're going to go through, like we always do with Jack, the types, and then we're going to talk about current environment, et cetera. But quickly, Jack, can you go through the types of long-term care that um, you offer and show and recommend if it's suitable?
and so keep it simple. There's really, let's just say, there's two types of policies. We have long-term care insurance, what's standalone traditional long-term care insurance. Use it or lose it coverage works just like your health insurance, your
Mm-hmm.
auto insurance, your homeowner's insurance. You own a policy, and if you happen to need long-term care, if you become chronically ill, the company will pay you benefits. You will stop paying premiums, just insurance for
And this
healthcare
is the
costs.
hardest one to get, right? Because the underwriting is the way I understand it, the underwriting is more significant because you're not lump summing it, you're paying into it, correct?
So I will say this. I mean, it is the hardest to get, only because the arena is limited. We have 5 underwriters left in the arena, and that's it. And as
In the
part of
country. In the country.
correct, there's 5 companies left. Now,
Wow.
with traditional long-term care insurance, all 5 underwriters have a requirement to order medical records. So the reason I think it's harder to get because they will always order medical records no matter what. You have a telephone interview and medical records.
Mm-hmm.
And the more records that an underwriter gets to review your health history, well, the less likely it may be that you will be approved for coverage, right?
Mm-hmm.
But that's the traditional long-term care insurance, no cash value. Premiums are not guaranteed. And yes, it can be the hardest to be underwritten just because they will always get medical records. The second type of policy, as you've mentioned already, Stan, the asset-based arena. Now, asset-based can cover either policies where the asset is a life insurance policy or where the asset is an annuity.
And
Okay,
let's
so
stop
that's
right
just
there for a second.
okay.
Life insurance companies issue annuities. Those are life insurance products. When we go into long-term care, that is a health insurance product. Okay. So there's a lot of misinformation out there at the bad chicken dinner, expensive steak dinner seminar that they're saying, hey, I've got this index annuity with an income rider and covers for long-term care. That is absolutely categorically and factually false. Go.
Well, so to keep the asset-based arena simple, how our clients should view these products vis-a-vis the traditional products is they've really morphed into a fixed cost return of premium long-term care policy. So let me say that again. Fixed cost, your premiums cannot change, unlike the standalone policies where the premiums are not guaranteed.
Right.
And a return of premium if you do not need care. So the money that you're paying for the policy, if you do not need care at death, you receive essentially your money back. Whether it's the annuity cash value or whether it's the life insurance death benefit, it's essentially a return of premium long-term care policy with guaranteed costs. So yes, these have become the most popular way to plan for long-term care today. The underwriting is easier in the sense that you have a telephone interview, but if they like what they hear, you can be approved without the ordering of medical records. So that's why it's easier in the sense that you can control the narrative. And I mean, we want you to be clients to be honest and reveal everything, etc.
Sure.
But it goes without saying that if they like the story after the interview, you will be approved without ordering medical records and having an underwriter stumble upon something that maybe you didn't know about, etc. So the underwriting's easier to get the asset-based policies for sure.
With the demographic tidal wave that me and you are both in, which is the 12,000 plus baby boomers hitting 65 every single day, have you seen a rush for coverage or a rush for an analysis of coverage they already have? Have you seen things pick up just based upon who we are as a country and the fact that
Yes.
we're aging?
Yes. I mean, there's a number of factors that are playing into it now, but yes, the baby boomers now are caring for aging parents. I mean, just
They're
like
in
you
our
and I are going.
situation, and it's a
It's our
wake-up call.
situation, right?
Yeah.
This is where we are at right now. Our
Mhm.
parents, mid 80s, later 80s, needing care.
Yep.
The caregiving of our parents is what is the catalyst for all of the planning that we're doing now. I mean, because listen, I started in this business, Dan. I was 30 years old.
You're like 35 now, right?
Yeah, but I mean, so I was 30,
How long have you been
right?
doing
So
this, Jack? How long have you been doing
27 years now.
it?
So
27 years. Okay.
so while I knew everything about the products, the contracts, the underwriting, I had all the analytical knowledge, at 30, 35, 40, 45, but I did
Sure.
not have what I have today, which is actually managing the care of parents and going through it personally. And it's,
Hmm, hmm, hmm.
it puts a different spin on it. And when we took out our policies, my wife and I mean, the reason we did it, we didn't want to have to burden our children with these issues.
Yep.
You know, when we're in our 80s and they have their own lives, that was our motivating factor when we did it, even though we still had not lived through it ourselves. But now that we're actually living through it, it's crystallized it. I mean, I
Yep.
am just so happy that we have our coverage already in force and paid for,
Sure.
and um, but yeah, today with the baby boomers experiencing
Yeah.
this with their parents, it's created a lot of interest in long-term care planning, for certain. I mean, my phone rings off the hook.
I
So,
know. I know. We
um,
so treasure you helping our clients for sure. Tell us about interest rates. I mean, the Fed keeps bumping, and we have 33 trillion in debt, and it's not sustainable. And but we're at 20-year highs. How's that played into your world, Jack?
I mean, and so that's the other issue, just as far as, you know, recency in the last 12 to 18 months.
Mm-hmm.
So in the long-term care arena, the interest rates drive the pricing of the policies, right? Low interest rate environment, higher premiums, because the companies get less money when interest rates are low from the premium that you write to the insurance company. So they have to
Sure.
raise costs.
Sure.
In the past 18 months, and specifically even in the past, say, 8 or 9 months, we have had pricing decreases on these policies, and specifically the asset-based policies. 25% decrease costs today with a number of companies versus January of this year. 25%. So we're getting just a lot of interest now with where the pricing is too, where the policies look very, very, very attractive from a value standpoint today with the higher interest rates. Um, the asset-based annuities, they're paying 5%
Yeah.
on cash values today as
Yeah.
well. So even with that subset, 5%, the cost of a long-term care, the morbidity cost inside a long-term care annuity is about 2% a year. You know, 3 years ago, the
Yeah.
interest rates weren't covering the cost of insurance. Now,
Now. Yeah. Now
three
it's good.
percent, right? So the policies, have extreme value just relative, to the benefits that consumers are receiving today for sure.
By the way, we're talking to Jack Lenenberg. He is the president, CEO, founder of in fact, in my opinion, the number one source for everything long-term care. He is the guy, as you just told you, 27 years of experience in the long-term care arena. His website is LTC Partner. That's a singular, not partners, partner. LTCpartner.com. I'd encourage you to go there and talk with Jack. If you've ever talked with me, he's nicer than me, but as brutally factual. How about that? But he's fantastic, and we've been referring people to him, and I've yet to hear someone say anything negative. Um, people sometimes, Jack, don't get my loving abrasiveness sometimes when I talk to people, but it is what it is. What's the future of long-term care, Jack? Are we going to see more carriers, more products, or is it going to be a slow bleed dwindling?
It's a good question, Stan. And I would like to hope that we will have new underwriters enter the arena. I do know there is one underwriter that is bringing a new, a new product for them sometime in 2024.
Right.
It's also in the asset-based arena. So
Okay.
the asset-based arena will increase in underwriters for sure. The traditional arena will bleed a slow death. So that's what, we're going to see the separation continue.
Okay.
Um,
And the
but
traditional long-term care for those people out there, that's when you buy the long-term care, you put monthly premiums in, etc. Um, and then if you don't use it, you use it or lose it, as Jack said. But I think would you say the vast majority of policies sold today are asset-based?
100%. I mean, to go
Good.
back to my
Okay.
point about the rate decreases that we had in the
Mm-hmm.
arena, 25%, they
Okay.
were only on the asset-based side. The traditional underwriters, which increased premiums by 35% in 2019 and 20, have yet to move back down. So, it just tells you that I mean, they just don't have, the market share anymore. They're not getting the business, the premiums. So certainly I think the traditional side, 5 years from now, I think it will be completely dead. So
As the song goes, Jack, the future's so bright I have to wear shades. You're not wearing shades, but are your glasses tinted? Do you see a bright future for long-term care?
I certainly see a future. And I would say it's bright in this regard. If in fact we are moving to the asset-based space where premiums are guaranteed, to me, that's a win. It's a win for consumers if all the policies have guaranteed fixed premiums and we cannot get a rate increase if a company has poor claims experience. So that to me is a bright future in that regard. We don't have to manage rate increases anymore, where clients have had policies for 10 or 15 years, and then the insurance company sends a letter requesting more money. So I can see it being bright in that regard. Would I like to have more underwriters enter the arena? Sure. But the underwriters that we do have are all A++ rated, so they're all solvent and highly rated. So the underwriters we have in the arena right now are the companies you want backing the business.
Mm-hmm.
It's bright in that
And Jack
regard.
represents everybody. He's got no skin in the game with any of these people. He's just finding the best policy with the best claims paying ability carrier, and he matches you up with that after shopping on carriers. So he's not beholden to one. He's just like me. I think I know the answer to this question, but I'm going to ask because there's a lot of people out there that ask me this question about timing it. Can I time it, Jack? Can I find the sweet spot for long-term care purchasing? I'm assuming the answer is no. Correct me if I'm wrong.
The answer is no. The best timing to obtain coverage is when you are concerned about planning long-term care,
Right.
when you do not want to burden your family with these issues, and when you have the resources to be able to fund a plan. And if you're healthy enough to get a policy and you have the resources, yes, by all means, that is the perfect time to buy your coverage. You cannot wait until the accident has happened to try to throw on your seatbelt. You cannot call me
Nice.
right after you've had a visit to your doctor and try to get coverage. It will not work. It just does not work that way. You can't wait for the perfect day to buy a policy after you've been diagnosed with a chronic illness.
And you have to come forward with everything. You
And they
can't
know.
hold back. They know. They're
They know
going to know, and they're
because
going to know.
they all do electronic prescription drug reports. They know every medication that everyone's been prescribed in 5 years. So we can't hide anything.
Right. So you can't say, Jack, I was taking the blood pressure medicine because it helped me exercise better.
Yeah. No, it's the sooner everybody plans, the better, Stan. It goes without saying.
Yeah. You're transferring risk. You're transferring risk to the long-term care carrier to absorb that risk, similar to if you're buying a lifetime income annuity, you're transferring risk to that annuity company to pay for as long as you are breathing. So I think the timing issue, I think people have a hard time, Jack, when they go to people like us that are selling contractual guarantees, because they come from an investment world of timing things, trying to find a sweet spot, trying to find an arbitrage moment that they can beat them, right? We're always looking to win. We're a winning society, United States. But as Jack says, winning is transferring the risk. Winning is getting that coverage. Winning is being able to pay for that coverage. And it's a different mindset. I tell people that all the time. It's just a different mindset. There is loss of opportunity. You're not going to buy the next Tesla and the next Google or whatever the stock of du jour is today, but you are taking care of things and what I call checking the boxes. And long-term care is a checking of the boxes. One thing's on my mind, Jack, and I don't know what your opinion is, because no one has the future in front of them. Do you see a future where the Obamacare type coverage will either invade aggressively the long-term care space or take it over?
Here's what's happening. So that's a great question.
Of course it
And
is.
this
I
is,
asked it.
yeah,
You know what I'm
this is
saying?
what we're, so by Obamacare, I'm going to say the government getting involved in long-term care, right?
Mm-hmm.
And
Mm-hmm.
it is happening, and here's how it's happening.
Okay.
All right. 2021, we had the first state, the state of Washington,
I
passed
remember that.
a long-term care payroll tax. What Washington did was they said, we're going to tax every employee in our state 0.6% of income to fund
Long-term care
long-term
for the
care for
masses.
Washingtonians.
Exactly.
And so in 2021, everyone who resided in Washington were calling me because there was an opt-out provision. If you buy long-term care insurance privately, you won't pay the tax.
And when he says everyone, he's not kidding. I remember
It
that
was
time.
unbelievable. The whole state is like, so 35, 40, 45-year-olds, all the
Yeah.
Boeing employees and the
Yeah.
Microsoft engineers are calling me to buy coverage, not really because they thought they wanted to do long-term care planning at age 35 or 40. They
Yeah.
just wanted they didn't want to be taxed. They didn't want the state to tax their income to pay for future care of residents.
Right.
So that was 2021, Washington. Now, here's where we are at today. 12 more states are exploring payroll
Only
tax.
12?
Oh, it's going to end up being 50. But
Of
right now we
course.
have 12 more that have plans. I mean, some of them off the top of my head. California is next, by the way. California is next year.
Ugh.
Michigan, Oregon, North Carolina, Pennsylvania, Hawaii, Colorado, Minnesota. So
You
these
need
states
to
are,
add more phone lines, Jack. I'm just letting you know it's a business
here's
owner.
here's what California is doing. Washington, 0.6%.
Yeah.
California, lovely state, 2%. Progressive
Ouch.
tax of 2% of income.
Ah.
2%.
Ah. I know, for all you people saying, oh, you rich people can afford it. Trust me, they're going after everybody. Okay.
But here's the bottom line. This is what people need to know if they are employees of these states with payroll tax. What the state is providing to the employees for what they are being taxed is peanuts. So Washington was given 1 year of benefits, $3,000 a month, a $36,000 long-term care plan, which is nothing.
No.
$36,000 for all the residents who need care, who are vested in the plan, and all of the employees are being taxed to subsidize the cost of a $36,000 policy. California is looking at a little bit more comprehensive coverage, but 2% of income?
Wow.
For what you will have to pay in taxes if you live in California or in one of these states, you can get so much more coverage privately than what the state is going to give you.
There's just
So
going to
much
be a
more coverage for
continued
the premium.
exodus out of these states. Their people are going to leave the states.
Well, the states just want to incentivize people to plan for long-term care. That's what they want. The Medicaid doesn't have the money to pay for it.
I understand that.
Yeah.
But there's a reaction to the action.
That's right. That's right. But if there are, residents of these states that are faced with a payroll tax, my advice just is explore your options.
Mm-hmm.
You will almost certainly do better outside of whatever money the state will provide in the form of a public benefit.
Yeah, no doubt.
Always do better privately.
No doubt about it. Wow. So the next couple of years, your phone's ringing off the hook. You need to get a headset, Jack.
Well, and what happened in Washington is the insurance underwriters refused to sell them policies after about 45 days.
I remember that. It was a
They
complete
refused
crapola show. I know.
because that's right, because they received too many applications, and the underwriting departments were throttled with a bottleneck. So, I mean, certainly for
Mhm.
Californians right now, it would behoove everyone in California who does not want to be subject to a payroll tax to actually just go ahead and get coverage so that they can opt out before the insurance companies,
Shut
shut
it
off the
down.
faucet, shut it
That
down. That's
that's
right.
called skating to where the puck's going to be instead of skating behind the puck, i.e. Wayne Gretzky, but this is a long-term care Wayne Gretzky analogy. Got another hot question for you, Jack Lenenberg. Jack Lenenberg, longtermcarepartner.com, but it's not long-term care spelled out. It's ltcpartner.com. He's the guy. He's the number one, in my opinion, the number one expert in long-term care on this planet. And if you want to argue with that, then bring it on. I think I'm going to win. The question, Jack, how much money do I need to have to self-insure? Is there such a thing? Is there such a thing, Jack Lenenberg?
Well, I mean, right now, my father's nursing home costs are $12,000 a month. His wife's memory care cost will be 12,000 a month, 13,000 maybe for her. It's 25,000 a month.
So the
And that's
question
today.
is, you tell me, right? I mean,
That's today, right? Let's
oh,
say
geez.
let's
Yeah.
say you're a couple that's 60 years old and you're 25 years away.
Mm.
And nursing home care is 12,000 today. It's 35,000 a month for nursing home in 25 years. It's a big number, Stan. I mean, it's a big number.
In full disclosure, Jack did the factual backhand to me. He didn't literally hit me, but he did the factual backhand to me. Because for a long, long time, I was under the assumption, and I'm not going to give away the multiple millions of dollars that I would say is the bogey for self-insurance. And then Jack ran the numbers. He said, Stan, don't say that, because everyone's different. There's not a solution or a bogey or a number. It really comes down to running that $12,000 a month number, or what it will be down the road. And if that makes sense, if you live for 3 or 5 years, that's a big, 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 big number. And just like we buy home insurance, fire insurance, car insurance, Florida flood insurance, hello, hurricane insurance, it's nice to have it, right?
Yeah, and the earlier that people plan, the better, Stan. I mean, so
Yeah.
I think a quick example. Let's say a couple is in their 50s, and if they could set aside a couple $100,000 in a joint policy today, when they're 85, that could give them, I mean, $200,000 could be leveraged into about 2.5 million of coverage at age 85 for a 50-year-old couple today of guaranteed benefits. So it's like a
Nice.
12 to 1 leverage play,
And
right?
just remember what Jack said earlier. In an asset-based policy, that 200,000 is not going anywhere.
Right.
I mean, you're not losing it. It's not going down the rabbit hole. It's not one thing, well, I'm not going to do that, Stan, because the long-term care company keeps the money. No. What he's saying is you can leverage it, control it, and the family gets it if you don't use it.
Right. So it's, we could move $200,000, turn it into 2.5 million, and if care is not needed, you get the $200,000 back. So and people can put
It's
in as much or as little money as they want, but the
Yep.
leverage is still there. So it makes sense. I think most people underestimate the actual cost of care today.
Oh gosh,
I mean,
yeah.
these are just big numbers today.
No doubt.
Care costs per month. So can people self-insure? sure a lot of people can. It's just, as you mentioned, is that the best use of what you've worked for and saved,
Hmm.
to go through it all at the end? I mean, there can be better ways to do this. I'm
Are
happy
there,
about my policy.
yeah, exactly. Are there capacity issues with these carriers? I mean, can they, is there a limit to what they take? Is there, I know that you talked about earlier when Washington did what they did and what California's getting ready to what they do, et cetera. These carriers are going to be overwhelmed.
Well,
Is
okay,
is there a time that they go no mas no mas? Boxing analogy, by the way.
I mean, the only time they've ever done that was the state of Washington, and candidly, that was because they received hundreds of thousands of applications, and they didn't have the resources to process it. And also, what the state residents were asking for, wasn't conducive to running business. Most people say, I want to buy the minimum amount of coverage to get out of a payroll tax. It was just a unique situation. Outside of that issue arising again, no, they have the capacity.
Okay.
The companies will allow anyone to purchase anywhere from, in benefits, 2,000 to 20,000 a month. So most people can find,
Yeah.
a comfortable amount
Right.
of coverage, minimum to maximum, with any company. Um, so no, I don't think that they will issue what people want if people are healthy enough to qualify for coverage. So
Do you think the long-term care industry has done a good job educating the public?
probably not. Probably not. Um,
I agree. I mean, I
Probably,
agree totally.
I think it's not the largest arena, right, to begin with.
And
Um,
neither is the annuity space, but the
right,
annuity
we're
has
both.
done a bad job of that as well. I think that I'm just Jack. I'm think you be czar. We could have double czar offices. It could be adjoining, so we could watch sports. But you being the long term care czar, I be the annuity czar. Things would change because I think people would fully understand, and they need to what is out there because there's a lot of misconceptions, etc. Do you see blowback from the planners of the world and the RIAs of the world with long-term care? Are they becoming more open to this as part of the portfolio as they should?
Some are open. Um, there is, I see a lot of bad guidance from a
Mm-hmm.
lot of financial advisors on a daily basis. I see a lot of
Amen to that.
poor advice from a lot of financial planners on a
Mm-hmm.
daily basis. Um, my gut instinct is a lot of financial planners, they may not be knowledgeable with long-term care insurance per se. And I think if a financial planner does not have the requisite knowledge about a product, it's easier to say, don't buy it, you can self-insure,
Right.
and avoid the conversation, than rather, giving proper guidance to their clientele. Um,
I
so
agree with
I
that. That's
that
well put. Well
Yeah,
put.
and I think also part of it could be that sometimes financial advisors don't know what they don't know because maybe they haven't been caregivers yet
They don't have the scar.
for their parents.
Right.
So without the experience, they might not know everything that it entails, both from an emotional standpoint and a monetary standpoint. And I think the default also is if they don't have the knowledge. And a lot of my clients who come to me and work with me, they tell me all the time that their financial advisors couldn't answer any of their questions. So that leads me to believe that they just don't know the products. They're not familiar with it. It's not what they do. Um, So yes, I think if it's not what they do, then it's easier to say, tell their clients, don't do anything.
Yeah, I mean, I run into the same thing. All annuities are bad. All annuities are expensive. Never buy an annuity. You already own one, player. It's called Social
Social
Security.
Security.
Come on. So don't be a hypocrite. But I think that it'd be like me commenting on ballet. You don't want that, Jack, because I don't know anything about it. Let's talk about the process a little bit. I mean, just from a 30,000-foot Jack Lenenberg, LTCpartner.com view, um, start to finish on non-asset based and then asset based products. If someone says, "Yep, Jack, ready to roll, let's do this thing," what are you seeing ballpark time frame wise, start to finish? At the time
Traditional.
of this taping, look at the date, please.
All right, we'll start with the policies that most people aren't buying. Traditional policies,
Okay.
4 to 6 weeks, telephone health interview, medical records will be ordered. So it just takes 2 to 4 weeks to get the
Yeah.
records in house and then reviewed, another 5 to 10 business days. So 6 week process
Got it.
easily
Got
on a
it.
standalone policy. On an asset-based policy, telephone health interview. So if I complete an application for my client today, they immediately get a link to schedule the interview. They can have it done in 3 or 4 days. From there, 3 to 5 business days, it can be reviewed. Policy can be approved easily within 10 to 14 days after speaking with me and issued.
That's fantastic. And people need to know that. If you haven't caught it yet, just by the cadence when Jack and I talk, I mean, we're not hammers looking for nails. I mean, we're not close, 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 close. We're not those people. I mean, we're trying to solve the problem if it needs to be solved, and we are very secure enough with ourselves to say you don't need it or you don't qualify for it or this isn't the right time or whatever. What are some just general things health are there this might be a bad question, so smack me down. Are there any general health care issues that would just preemptively from the get-go disqualify someone for looking at long-term care coverage of any type?
From the get-go, like
Mhm.
automatic knockouts,
Mhm.
memory loss,
Okay.
any diagnosis of early onset Alzheimer's or again Parkinson's, um, osteoporosis with a fracture is an automatic knockout if anyone's
Okay.
been diagnosed with that.
Okay. Interesting.
Um, multiple sclerosis, automatic knockout. I mean, I have a whole underwriting
But
book of.
but but what you're going to do when someone calls is you're going to ask basic questions. You've been to the rodeo before. The long-term care rodeo. You're going to tell people, "Hey, I just don't think this will go through," or "Hey, I'll give this a shot because I am Jack Lenenberg. I am Mr. Long-term Care. It is, I will do the best I can, but it might not go through." You gauge expectations going in, correct?
Of course, I mean, I pre-qualify all of my clients with my underwriters. I generally will always be able to find a policy for my clients. The most common chronic conditions can usually be underwritten: diabetes, um, arthritis, heart disease, cancer. These types of issues, if controlled, are fine for long-term care underwriting.
Got it.
What usually can trip people up is if, like physical therapy, if they're undergoing physical therapy today, we have to wait until the therapy is completed and they're released. So
Okay.
sometimes it's just a timing issue, but generally speaking, most people I can get policies for. But if somebody's undergoing cancer treatment right now or physical therapy, um, things like that, we're going to have to wait. We're
Got
going
it.
to have to wait. So
That's interesting.
it's a process, but
That
yes,
actually
I
turned
can.
into a good question, Jack. I wasn't sure, but I mean, I learn every time I'm on with you or I'm hanging out with you. And Jack was gracious enough to fly into Vegas when I was the last time I was in Vegas, and we hung out a little bit. I learned things. I learned things about long-term care so that I can be a better referral source for people that are looking for that. Again, ltcpartner.com. His name is Jack Lenenberg. As I always do, Jack, at the end of the, and we've gone a long time. I'm looking at the clock. I'm like, holy mackerel. But as I always do, Jack, I do a mic drop moment where I count it down from 5, and then I hand over the mic to you. And you, at that point, are going to say something so incredible, incredibly insightful, smart, and long lasting for the fans out here that we're all going to be amazed. So no pressure at all.
Oh, Stan, come on.
Here we go. 5, 4, 3, 2, 1, go. Come on.
Stan is not a U2 fan.
That is true. And I did see them
That's
at the
as
Sphere.
insightful as I can get.
I did see them at the Las Vegas Sphere the other night with a good friend, and it was forget the music. That show's amazing. Just the
So
lights.
you did go.
I did go. I'm not going to tell anyone what I pay for the tickets. And the only thing I can also tell people is when you're buying tickets, do not buy in section 100, buy in section 200, 300, or the floor. You will thank me for that. Otherwise, if you buy in section 100, you'll have an obstructive view. No, I was not there, but I was on the floor. Real close to Bono, because Bono, that's barbecue. Bono, because I'm close to him. Bono and I are friends, as you know. You didn't know that, did you? Listen, Jack, I was looking for something insightful about finances, long-term care, and you hit me with U2, which is good because then I had to recover, which is, what the commissioner does, that's my name for Jack, the commish. He's the commissioner of everything long-term care. Jack, I really appreciate you being on, and I appreciate every single person out there on all major podcast platforms listening to this. Boy, are we growing. And also watching us on the Fun with Annuities YouTube channel, where you see my midlife crisis happening real time with some facial hair. Jack, my wife's not thrilled about that. You can barely see it, but it's coming. Gonna grow the annuity goatee.
Youthful. It makes you look young.
I don't know about that. Listen, thanks everybody for joining us. We'll see you next time.